All right, getting back into partnerships. We've got partnership taxable income. Entity must calculate taxable income before allocating to partners. Fairly obvious, right? If you've got 10 partners and you have 100,000 of income for the partnership, you got to do that calculation before you calculate that each partner gets 10,000. Some deductions are taken at the entity level, some are at the individual level, separately stated. Also, unreimbursed partnership expenses. Separately stated items are deducted on partners' individual tax return. So instead of flowing through, it's just on their tax. And we've got the qualified business income deduction, commonly referred to as QBI, permits a 20% of pass-through income to be excluded from taxable income. And if you remember from last week, that is available to partnerships, S corps, and Schedule Cs, and not C corporations. So QBI limitations, the deduction is limited to the lesser of combined qualified business income of the taxpayer or 20% of the excess of taxable income over any net capital gain. QBI is defined as the net amount of amounts of items of income, gain, deduction, and loss effectively connected to a U.S. traded business. It's commonly the 20%. That's typically what that deduction is. Here we have certain items excluded from QBI, investment-related items such as capital gains and losses, dividends, interest income, employee compensation, and guaranteed payments. Guaranteed payments is a big one. We'll get into it a little bit more, but guaranteed payments differ from distributions, right? As a partner, you can take distributions as long as the partnership agreement states that you can. Guaranteed payments act more as a salary of sorts. They get treated differently, but they're substantially similar. But a guaranteed payment is, you got a partner that gets $1,000 every week. That's going to be considered a guaranteed payment. If they take out $10,000 once a quarter, that's going to be treated as distribution. So they're similar, but the tax consequences of each vary. QBI limitations for service providers. QBI available to service providers, think lawyers, accountants, consulting firms, can deduct only if the income is below a certain threshold, and that's 182,100 for single and 364,200 for married filing joint. W-2 wages limitation. QBI is defined as the lesser of 20% of qualified business income or the greater of the following: 50% of W-2 wages allocable to the taxpayer by the business, or 25% of allocable W-2 wages plus 2.5% of the allocable share of the unadjusted basis of qualified property immediately after it has been acquired. Generally, it's going to be this first one, 20% of qualified business income, just because 50% of W-2 wages out of the taxpayer by the business, it's going to be less than the 20% of the business. That being said, to get QBI, you do have to have income. You can't recognize QBI for loss. Allocation of expenses to partners, those are separately stated. So it goes right on their tax return, not the partnership, 1065. And then we've got ones that are deducted at the partnership level. That would be 1065 deductions. Separately stated items, section 702. Again, go to section 700. You're going to see it all the time in partnerships. Long-term and short-term capital gain losses, section 1231 gains and losses, unrecaptured 1250 gains, charitable deductions. So charitable deductions get reported right. They get allocated to the partner and they go right on their Schedule A. Section 179, dividends, interest, tax-exempt interest and credits, foreign taxes, and other items allowed by Treasury regulations and instructions. So we've got entity level ordinary income loss, partnership level income deductions, and gains and losses are everything else not separately stated. So those are your 162 deductions. Partnership then allocates a share of its ordinary income loss for section 74. Partner then reflects the K1 information on Form 1040 Schedule E. So it's, you get a K1 and that's where you enter that information. So the partnership will actually spit out this K1 saying, partner A, this is their share of gains and losses, and then partner A would report that on their personal 1040. That's what's meant by pass-through. Limitations on net business interest deduction. So the business interest is deductible at an entity level, limited to the sum of business interest income, 30% of adjusted taxable income, but not less than zero. And floor plan financing interest vehicles. We covered this in an earlier chapter. I don't think it was last week, but we did kind of go through this a little bit. The same rules as applies to S corps, right? It's you can't uh, declare unreal amount of business interest expense, right? It's going to be generally these first two, the business interest income or the 30% of adjusted taxable income. So taxpayers meeting the 29 million gross receipts test for small businesses that are exempt from this limitation. Adjusted taxable income for this purpose means taxable income computed without regard to income gain, deduction, or loss not eligible to a trade or business interest or business interest income, any net operating loss carryovers, qualified business income deduction, any deduction allowable for depreciation, amortization, and depletion during 2021 or prior, and any other adjustments provided by the Treasury Department. Right, so kind of what you would expect to see, right? And this partnership's AGI doesn't recognize income gain deduction or loss not allocable to a traded business. Like that makes sense. So we've got the partner's source of tax information. We've got the separately stated items, right? That goes right on the partner's 1040. And then we've got the partnership ordinary income allocated. That's the K1. You add those two together. That's what gets reported on the partner's 1040. So getting into the special allocations, we've got a partnership agreement, or if there isn't one, section 704 is going to govern that. And the partnership agreement, anytime I start working on a partnership, I ask to see the partnership agreement. That's going to spell out everything that you're going to need to. Because partnerships can get very complex very quickly. So it's looking over the partnership agreement. I mean, I've seen some that are a couple hundred pages. It's you want things to be as specific as they can be, because that leaves, if it's not, it's open to interpretation, which you don't want. Special allocations give a partner more income deductions or gains losses than under normal distribution rules. If no substantial economic effect, the default is allocating per the partner's interest. And the substantial economic effect we're going to get into, but that's a big driver of this. So we've got the required special allocations for contributed property. That moves up to other special allocations as long as they have substantial economic effect, and then that gets allocated to the partner. Getting into the substantial economic effect theory again, it's got to be substantial, it's got to be economic. That's how you get there. And we're going to get into what those terms mean, but just understand that you need both, right? It can't be one or the other. It's got to be substantial. It's got to have economic. So definition of substantial, a reasonable possibility exists that allocation will substantially affect dollar amounts to be received by partners irrespective of tax consequences. And shifting allocation doesn't mean it's substantial. It just means you shifted allocation. Economic effect, you got to meet all of them. Allocation results in appropriate increase, decrease in partner's capital account. Proceeds of any liquidation are distributed in accordance with positive capital account balances. Again, you can't have negative. You can be in the hole where you have to pay it back, but you basically can't go zero. Partners must make up negative balances upon liquidation of partnership. Now we're getting into outside basis. Partnership has acquired for reasons other than the contribution of property or services. And so it's a partner didn't contribute it. If inherited, the basis is equal to the fair market value of the date of death, similar to how estates and trusts work, right? We're just inheriting property. If gift, the basis is equal to the carryover from donor plus gift taxes paid, also similar, right? This is why you don't want to gift a house, you want to put it in your will that, hey, this house is going to go to person X because I'm going to step up in basis, whereas if you gift it, you get carryover. Effective liabilities on partners outside basis. So you've got your outside basis, add an increase in partnership, in share of partnership liabilities. You deduct decreases in share of partnership liabilities. So if you pay off a liability, that would be a deduction to basis. You add partnership liabilities assumed by the partner, and you deduct partner's liability assumed by the partnership. So if I have if I personally guarantee a debt on behalf of this partnership, that increases my basis. Right? I'm personally guaranteeing that, not the partnership, me. So I would get an increase to my basis in that partnership. So effective liabilities on partners outside basis, recourse debt increases the basis of partner who guarantees the debt, what I literally just went over. Non-recourse increases partner basis, but only to the extent it's allocated per profit ratio, and that is section 752. Recourse debt is going to always increase your basis. Non-recourse debt says, yeah, I'm only personally responsible to a point, and that's why it gets allocated per the profit ratio. So effective operations on partners outside basis. So here you've got your starting outside basis. You're going to add partnership taxable income. You're going to add tax exempt income. PPP loans were a big part of basis calculation back when the coronavirus was big and spreading. And no one really knew what to do with the PPP loans that were being offered by the government. And it was tax exempt income. And originally they said it's not an increase to basis. That kind of flew in the face of case law. So they said, okay, you get this PPP partnership, it's not taxable, and it is an increase to basis. It was an unruly good deal for partners or S corporations or whoever got it. You didn't have to recognize the income and you got an increase to your basis. Win-win. Anyways, I get distracted. You deduct any partnership losses and then you deduct any non-deductible expenses, or you would remove any deductible expenses. That wouldn't be part of your basis calculation. Now getting into loss limitations. Allocations of income or deductions cannot cause a partner's basis to go below zero. Cover that. The excess deductions are suspended and can be used to absorb future positive allocations, right? So if I had $100 loss this year, but my basis is zero, I don't get to recognize it. But next year it's going to be 100. I can offset that. It's an NOL that carries forward. If the partner sells interest, any suspended losses can be deducted. And we have special loss limitations, at-risk loss limitations, passive activity limitations, and excess business losses, which we'll get into here. So at-risk loss limitations prevents the taxpayers from increasing their basis with non-recourse debt and therefore taking more deductions. We kind of covered that. At risk means partner would actually lose the amount should the partnership become suddenly useless or insolvent. Deductions taken only to the extent the amount is at risk. Exception, qualified real estate financing. Right. So it's if I've got $100,000 debt and it's non-recourse for 50,000, I don't get to take the 100,000. I get to recognize the 50. Here we've got passive activity limitations, 3 categories of income, right? There's going to be 3 buckets. There's going to be your passive activity, income losses. There's going to be active material participation. I'm either actively participating in this partnership. I receive a W-2, that's ordinary income. And then finally, there's portfolio, dividends, interest, capital gains. So commonly referred to as investment, ordinary, and passive, right? Those are the 3 buckets of income that you've got. Ordinary, investment, passive. Passive activity limitations can't be used to offset the other categories. I can't declare a loss on a partnership and use that loss to offset my W-2 wages, right? Only passive gains can offset passive losses. So here's this last bullet point. Excess passive losses can be carried forward to offset future passive activity income. You can't use losses on passive activity to offset ordinary income or to offset investment. Right? They're kind of set up that way. So gains in one can only offset losses, or losses in one can only offset gains. You can't really recharacterize at will. Now, if this was a material participation, then it would be ordinary income. And if I had a loss in a partnership, then I could offset my W-2 income. But if it's passive, then I can't. Excess business losses for tax years beginning 2018 and before January 2026. Non-corporate taxpayers cannot deduct excess business losses. Disallowed excess business losses carry over as an NOL. Limitation applies at partner or shareholder level, shareholder for S corporations, partner for partnerships. Excess business losses is defined as the excess of aggregate deductions for the year attributable to trades or businesses over the sum of aggregate trade or business gross income or gain attributable plus 289,000. You don't often see a lot of excess business losses, but understand that you can't deduct it immediately. You can have disallowed losses on that. So transactions between partner and partnership. Partners who render services to the partnership may be compensated with guaranteed payments. Characteristics of guaranteed payments also distributed for use of invested capital. It's supposed to be separate from normal distributions, share, and are ordinary income to the partner. Right? It's similar, but it's different. Guaranteed payments are essentially it's a wage, but as a partner, you don't get a wage. You don't get a W-2 as a partner. You get guaranteed payments. And it's ordinary income. You're not paying self-employment taxes on it, which is why on your 1040 you're going to owe self-employment taxes, right? There's no FICA deduction for partners. They have to recognize that individually. The partnership doesn't recognize it. The partner does. Here, getting into compliance issues, you've got the partnership return. That's the 1065. Partner form is the K1. Partnership must file a Schedule M3 instead of M1 if certain criteria are met. That's certain book tax reconciliation differences. Here we've got a Section 444 election for changing the tax year. Partnership may be required to make a deposit. Partners must make their own estimated tax payments, and partners may have self-employment income. And self-employment income, just going over that again, because I feel like a lot of people who get into this don't understand how big of a tax liability that is. It's 92.35%. So if this partnership had $100,000 in income, and you have two partners, 25 considered the two partners. On that, you're gonna have self-employment tax of $7,065. And that's before it gets added to your ordinary income. So it's going to be taxed at your ordinary tax rate or your marginal tax rate. The $7,065, it's just added self-employment tax. It is a huge burden that a lot of people don't understand they're going to be facing when you call them up and say, hey, you owe, $30,000 in taxes. It's, yeah, a lot of people don't have a solid understanding of self-employment tax when it comes into play. Comes into play a lot with partnerships, not so much with S corporations, which is kind of the benefit of an S corp. So I really like to point that out to people that, hey, this is going to be your self-employment tax liability, not recognizing ordinary income, just the self-employment tax portion. But so anyways, that covers what we've got for partnerships. All right, and then we will get into S corps in another video. All right, thanks everyone.